the two things we want to open our Google Classroom. Jonah, you're here. And your accounting. Okay. And we'll just kind of talk briefly. The first thing we're going to do that I want to just kind of show you is if you click on this classwork tab, right, you have all the different weeks we have, week 2, week 3, week 4. So we just got done with week 3. Accounting concepts always can be used on the test. We had our sheets that we were doing the test. We're making sure we had done with the application problem. So I got all that stuff. Hopefully you're good to go. If there's something that you still don't like about, with like, I needed more time, or I don't like the score, just come down and see me when we get done talking, and I can extend like, hey, can I extend study guide? Can I extend 1-3? Can I extend whatever you like? That doesn't have to be a thing that you need to do out loud with everybody, but you can come down or email me. So that would be something you want to do. Now, week 4, this is what I want to show you. So week 4 has a bunch of different stuff on there. And you can see is it has, I don't know why the YouTube, whenever I put 2.1, it always deletes it. But we have 2.1 notes. And what I did with 2.1 notes is I just have all the highlights down on this sheet. Now, I took screenshots, so sometimes they're not very big. Okay, but they're there. And it's there for you, okay? 2.1 work together. Video shows you the answers, how we got about it, just walking through that. Same would be with 2.2 notes. Again, I took some screenshots, so some of them are kind of small, you have to zoom in, and then the other ones are kind of bigger. It just kind of depends. So just, if you wanted, those are there. What do we do with these? Why'd you do it? For people that aren't in class, or for you as a resource when you're not in class. I think the notes will be helpful. So like this chart is extremely helpful. This chart is something we're going to talk about a lot today. This explains what we're doing. And so it's on your notes. You can use it if you want. You don't have to. Again, video for 2.2. Work together. And so that's what we're going to do. We're going to go, I don't know why I got to verify now again. I'm in Google. Why would I have to do that? Okay. But that's what we're going to work on today. 2.1 and 2.2. And that's on your Google page. This we'll try to put resources up there so you can see them all the time before, on Monday. So you know what's going on. You don't need an email. You just go here and you can check it out. Okay. All right. So we're going to work on 2. But first, I want you to kind of see up here a few things. So last chapter, we did the accounting equation, right? So what we did is we said assets have to equal liabilities and owner's equity. And so that's right here. Assets have to equal liabilities, owner's equity. Assets are things of value. Okay, what are things of value? Things that are going to have monetary value to us: cash, accounts receivable, supplies, prepaid insurance. Accounts receivable is when we make a sale on account. Somebody comes into our store, or we do a service, or we give them a product, and in and in return, and in return they give us, we bill them, and they have to pay us back later. So that's something of value. Insurance is something of value. We buy supplies with cash or on account. Those supplies are things of value. So assets are going to be a certain way. Okay. Liabilities are those accounts payables. That's when we go into the store and we buy supplies on account, we increase supplies because we have more supplies, but then we increase our bill. Okay. Owner's equity is kind of like what they describe it as our capital account. It's our sweat equity. How do you, owner's equity has a lot of stuff involved with it. If you invest money into the company, that's going to increase capital. You make a sale of account, you make a sale of cash, that'll increase capital. We're gonna have a sales account eventually. We're gonna have expenses when we have withdrawals and we take money out. But doing those plus minuses you did last time is not realistic in how we're gonna make and record journal entries. Okay, we gotta get it so that it's a little simpler. We can put it on these forms, then we can make our financial statements. So we're not doing pluses and minuses. So for this chapter, we're going to take those pluses and minuses a little bit, but we're going to use these T accounts where you can got a left side, right side, debits, credits, increases, decreases. And then we're going to take what we learned today, this chapter, and then chapter 3, we'll start journalizing. Okay. It'll make a little bit more sense when you start jumping in. Like I said, we're going to start adding some things to it. And so hopefully it'll make a little bit of sense. But for now, if you go into 2.1 where it says using T accounts, we can kind of get started. We're not going to get started yet because I'm way on the wrong side of the screen. And again, I have this highlighted in your, but if you, it might be easier to follow and do it on your own. Then you can use your book. So we're going to see the accounting equation in a T account, figure out what debits and credits, and increase things. So that's good. All right, so you guys can have this on your screen. Chapter 1 or chapter 2, section 1, a lot of this probably should be read. Now, again, I understand you're not reading, so I give you notes and highlighting stuff. But if you really wanted to know something, I would read it. Chapter 1's talking about the equation. I can zoom in a little bit. You guys can see it all right, but you can't read it. But on your screen, you probably can. And how it's not practical. So we kind of mentioned that right here. It says it's not practical to do pluses and minuses all over for all these transactions. You get a big business. It's just not worth it. Okay. So we need to figure out a way to journalize this stuff, make these transactions work for us. And so we're taking this again, accounting equations, assets equals liabilities, owner's equity, and we're going to make this thing called a T account. This little bar and this line is just kind of a way to kind of keep thinking organized. Assets over here have to equal both of these. We went over what assets are. We went over liabilities, our accounts payables, owner's equity, all the different things. So we kind of have an idea. This talks about that chart. Okay, so again, if you wanted to read it, I would probably read it. It'll probably help you. You go to the third page, says accounts. So when we have this T account, and again, what is an account? It's just a record. So like prepaid insurance is an account. Withdrawal is an account. Rent expense is an account, right? Cash is account. So it's just this record summarizing information from transactions that involve that item. So what we're going to do is put the account above this T account. We call it T account T, so that we can introduce and understand how this stuff works. So what's the T account? It's just this deal. They call it an accounting device to analyze transactions. That'll be a test study guide test question. Okay. Basically, what are we doing? We're going to have a transaction. We need to know what goes up, what goes down. So then we can analyze it. We're going to have things called debits and credits. Amount recorded on the left side, you see that word debit. We don't really work in a lot of absolutes, but debits are always on the left side, no matter what account. Debits are over here on the left. Credits are on the right side. It's not good, bad, bad, good, whatever. It's debits are on the left, credits are on the right. Always, for any account. When we used to write stuff down, and when we used to write things down, we would often put like DR for debit and CR for credit. So if I go on the board, really doesn't have a lot of meaning to you. If you happen to see it in a direction, maybe. But I used to write that stuff a lot on the boards, and now I don't do it as much. But occasionally, those are abbreviations. But for us right now, we know this T account is just this little idea, a way of understanding. They call it a learning device to help you understand accounting. We're just getting started with it. It's a good way of keeping things kind of organized to be beginners when we're learning it. That's all. Debits are on the left side, credits on the right. I think that's all that's on that one. Yeah. This is a great chart. It's a lot easier to see here. I don't know why the screenshot was so blurry. But this will show you again the accounting equation and the T account. And then assets, things of value, those four I have written on the board. They are going to be increased. You see here, it's a debit side increase. You increase with the debit. So, for example, if you had a company and somebody gave you $100 in cash, that would increase cash. So this would be up here, the word cash. Any asset would be an increase, it would be a debit. Anytime you pay, buy supplies on account, pay for insurance, or buy supplies with cash, pay for insurance, pay expenses, you will lower cash, right? You're paying cash. That will be a credit. And we just got to get to understand these. Accounts payable is any liability. I go into bond store and I buy supplies on account. I increase supplies with the debit because it's an asset. And I increase my account payable to bond to his company because I owe money. Accounts payables are bills, correct? That's good for his company. Okay. Capital accounts are a variety of different capital accounts. Usually we say the owner's name. Michael Delgado is our example for this, for his company. Capital, and then we would increase capital with the credit and decrease the debit. We want to make sure whatever we do, we're going to affect at least each transaction will affect at least two accounts, and then we keep this accounting equation even. This chart would be helpful. Okay, what we're going to do in our problem is go through this, and we're going to decide, we're going to have you write, or you'll choose debit, credit for all of them. Debit on the left, credit on the right. And it might seem redundant, but you got to get it down. The assets have a debit balance over here, or that is an increase on the debit side. It's a decrease on the credit side. And then the normal balance is there. And we haven't talked about normal, but that's what we're going to do for our problem. I think normal balance is down here. This is just explaining this chart. So if you were confused, I would have you ask you to read this. Look at that chart as you go through it. I just mentioned normal balance. We haven't scrolled down here. What is a normal balance? It's the side of the account that is increased. Cash, any assets, normal balance is the increase side. So normal balance is a synonym. It's the same thing as saying the increase side. Okay, they just use that term both times. If you wanted to lower an account, you would do the opposite of the normal balance, or the opposite of the increase side is the decrease side, right? Hopefully that makes sense. Okay, but anyway, I would read all this again. This all is just in paragraph form what this chart is telling you. Okay, they'll ask you credits. If you want questions, you want to increase accounts payable, you either A, debit, B, credit, C, whatever, blah, 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 and you're gonna have to know what it is. True or false, you lower an asset with the debit. False, you lower an asset with the credit. This chart will be incredibly helpful to you down the road. And we want you to use it as often as possible so that you can get it, so you understand it. Okay? All right, we're not doing anything with that. All right, that's 2-1. That's 2-1. You want to look at the work together? For those of you that are just joining us, I know we got some people online. In your weekly setup, as everybody's going, I'm talking to the Zoom people, sorry. We have notes. So what we went over, 2-1, and then the work together we're going to do now. We have 2-2 and the work together. Okay, and that's all underneath our weekly summary. Okay. All right, so let's do the working papers. 2-1. You guys remember how to get there? I got my cursor on it. You go down to end of lesson, go to working papers, 2-1, and we are in the work together. We're not doing the on your own, if you remember correctly. And I will try to zoom in so you can see a little better. You guys okay? Okay, good. All right. So our directions say for each T account, label the debit credit, select increase, decrease, and identify the normal balance. We already said normal balance is a synonym for increase. So it's always going to be the same side as the increase. So what you want to do, if you had a question, you could use that chart to help you with this. So cash, what do we say debits or credits? We don't have many absolutes, right? There's a lot of exceptions to everything. Debits are always on the left, credits are always on the right, no matter what account. So you choose debit to the left, credit to the right. Cash, accounts receivable, supplies, and prepaid insurance are all assets. So we'll do so it's the same. Okay. Debits are on the left, credits are on the right. How do we increase an asset? Well, from this chart, they told us we will debit the asset. The debit's on the left, we are going to increase on the left side. So we will increase on the left side. Well, how do you decrease it? You do the exact opposite. So if we increase on the left side, we decrease on the right. The normal balance, we said, can't see it, is the side of the account that's increased is the normal balance. So wherever the increase is the normal balance. Do you understand where we're getting this stuff from? Okay. All right. So accounts receivable is the same. It's an asset. So we increase with the debit, decrease with the credit. Normal balance is a debit. Oops. Fat fingers. Good call. Sorry. Debit, credit, debit, credit. I messed that up. All right. Supplies and insurance. These are still assets. So are you having a hard time? David, are you getting into accounting? Yeah, you gotta get in there. I bookmark it so you don't have to go to Google. Debit, supplies on the left. It's always a credit on the right, no matter what company. Debit on the left, credit on the right, no matter what account. Assets are increased with the debit, so you increase with the debit. You decrease an asset by crediting it. Normal balances are synonyms to increase. So if you want to increase it, you debit it. So we know what we're doing with our assets. Debit on the left, credit on the right, increase debit, decrease credit. The normal balance is a increase. Okay. Any questions on those four assets? They're all the same. And it seems redundant, but we need to get it down. So that's why we're talking through each one of them. We have two accounts payables. Accounts payable is a liability, meaning we're going to pay for something on account later. Okay. So a liability is over here on this side. But it doesn't matter because debits are always on the left and credits are always on the right. So that's an easy way to start. Debits are always on the left, credits are on the right. So liability, this picture shows us that the liability is increased with the credit. Completely different than our assets. So our increase is now on the credit side for accounts payable. the exact opposite, or you can see here the debit decrease, right? It says decrease any liability, accounts payable is a liability. What did we say normal balance is? It goes with the increase side. So accounts payable normal balance is a credit. And it tells us that right there. Amount accounts payable. So again, we decrease accounts payable with the debit, we increase it with the credit. Normal balance is always on the increase side, which is the credit for accounts payable. So those are the two, that's the liabilities. You all right? And Parker Vogel capital, debits are always on the left, credits are always on the right. On the capital, we decrease the debit side, we increase the credit side. The normal balance is the credit side because it's the side that increases. So far we have one side assets, the normal balance is a debit, and then the accounts payable is on the other side, normal balance is a credit, capital's normal balance is a credit. We'll break up capital in a bunch of different accounts later on. Any questions with that at all? Okay. Why don't we do this? Why don't we give you, say, like 10 minutes? Let's go down to the application problem because I want to help you with something. It won't take you very long. So if you don't remember how to get to the application problem, you go down to where it says apply your understanding and click on application 2.1. And it'll look a little different once you bring it up. So that's why I want to do this with you. I'm not going to do all of it with you. I'm going to do one line. So the directions tell you we need to select an account classification. So it's either asset, liability, owner's equity. You need to decide what side it increases on, what side it decreases on. And whatever side it increases on is the same as the normal balance, right? So whatever you say increases is normal balance. So we'll do the first one cash together. And again, what's helpful? This picture, if need be, if you can't. So cash is an asset. Its normal balance is increase side on the debit. If you increase the debit, you decrease the opposite side. Right here where it says credit decrease, right? You just got to read it. And then over here it says accounts normal balance. Well, the balance that's normal is the same as the increase side. And it says it right here, increase normal, increase normal, increase normal, right? So that's all you're doing. So we'll just give you 7 minutes. We'll see where we're at about 12:45. Work on the work together if you didn't finish it with us. And then the app, 12.1 app, and then we'll go over 12.2, or 2.2, sorry, not 12. We'll go over 2.2. We'll give you about 6 minutes, 7 minutes. Okay? I'll give you a few minutes to, once you get done, you can just kind of hang out, relax. Mason, again, here's the information. We got the summary here. You can go over and do this stuff. 2.1 notes. This is everything that we highlighted. A lot of good reading information's here. This chart's pretty good chart. Kind of summarizes things. And then we will go into the 2.2 stuff here in a moment. If you want help with the work together, it's right here for either section. And the notes will be here as well. But we're gonna give everybody time to work. We'll give them back in about 5 minutes. Yep. Like that. Okay. Looks like we're kind of sort of moving in the right direction on that. Was there any questions on what you're doing on 2-1 there? Not too bad being able to say debit or credit. Is the increase side, decrease side? All that was okay? Okay. We want to go over another section today. And I know it seems like we're doing a lot, but then that way, if we get moving on, you won't have any homework. So here's where we're at. Lesson 2.2, analyze transactions. Sorry. So here now, we are going to get transactions. We're going to read a transaction and how they affect these accounts. Okay. And then it has these questions. We'll kind of walk you through it. These charts are great examples. So here's an example again. Okay. If I had it says receipt cash from the owner as an investment. Receipt cash from the owner as investment, right? It has all this information. Again, the accounting equation up top, you got to know that. We have to know that the accounting equation needs to equal. But under it, we're going to use these T accounts like we have up here. And what you saw in basically your notes there with that chart, where we put account names above here, and then we do the T accounts like you see up there. That's what we're trying to do. Okay. And so they're going to tell you receive cash from owner's investment. This is a transaction. What you'll get used to is this is a transaction that a lot of times is at the beginning, right? We're working on sole proprietorship. So this person, so our example is Michael Delgado. And so Michael is going to invest $2,000 of his sweat equity of his own money, and we're going to call it capital. Okay. So we need to, each transaction affects 2 accounts. And so we know when it says receive cash, that cash is involved. It says from the owner as an investment. I wrote down over here invest. I'm just abbreviating. Investment is a capital. If you invest money, it'll increase capital. Okay, it's the money that you put in. So if we receive $2,000 in cash, we need to increase cash. How do you increase cash? If you don't remember, assets, cash is a debit. How do you increase capital? Capital is just like liability here. It's a credit. So we increase this side of the accounting equation for $2,000. We increase capital for $2,000. So the accounting equation still equals. Okay. Now underneath this, they're going to talk about different things. So chart of accounts will be chapter 4. Each transaction changes at least 2 accounts. We mentioned that. We'll give you that list of chart accounts as we get moving. Debits must equal credits. That's a question you always get. And then they have this all down here. I'm not going to read this every time. I will read it here right now. This is for people that if they're not reading and still having problems, they're not following those notes, they're still having problems. You know, if you follow all that, read it all, you should be pretty good. But there are people, so this helps. It analyzes that transaction, receive cash from owner's investment. So they ask questions. Which accounts are affected? Cash and capital. How is each account classified? Cash is an asset. Capital, Michael Delgado Capital is owner's equity. How is each classification changed? If an asset is added, a cash is increased. Assets are increased. We increase capital. Owner's equity is increased. How do you do that? If you don't remember, that's the chart. But then you say it out loud here or whatever you do. You think of it as you're going into this. But if you ever have a question, it's all right here. Receive cash from owner, increase cash, increase capital. Okay? You'll be asked to do that transaction. Paid cash for supplies. Paid cash for supplies. Again, those questions, I'm not going to read them all again, but it says which accounts are affected. Well, we know paying cash means what? Are we increasing or decreasing cash? It's going down, right? I pay you $1, I have one less dollar than I had. So we know when it says paid cash, you're going to credit cash because you're lowering the asset. What are we gaining when we pay cash for supplies? You're gaining supplies. Supplies are an asset. That means they increase with the debit. So on this transaction, you pay cash for supplies. We have two assets accounts being affected. Supplies are increased by $165 and cash is being decreased by $165. But the accounting equation still equals. If we had $10 on this side, 10 on this side, I gained $1, spent $1, I'd still have 10 over here, right? The accounting equation still equals. That's what they're talking about here. If one account is increased, another account on the same side of the equation must decrease. If we increase supplies when we pay cash, that means we must decrease cash. Okay? And they kind of walk through this whole thing. I'm not going to read it to you. If you wanted to read it, you're more than welcome to. The notes are on there too. You can see it, but it just describes this chart and what we just talked about. Okay? Pay cash for insurance. Again, we are dealing with two asset accounts on the left side of the account equation. It has nothing to do with accounts payable. It has nothing to do with investments or a sale on account or a sale for cash or withdrawal or expense, right? There's nothing to do with owner's equity or liabilities. Paid cash, cash credit. What are we gaining? Insurance. Insurance is the debit. So we paid $900. We gain $900 of insurance and we lose $900 of cash. Increase the asset, prepaid insurance. Decrease the asset, cash, the accounting equation still equals. If you do one to an asset or account on the same side, you must do the opposite. Increase insurance, decrease cash. Again, you can go through the step-by-step process down here if you wish. You all right with those two? Paid cash for insurance, paid cash for supplies, pretty much the same thing. Okay. All right, we had investment, and then we had that one. Next one, bought supplies on account. When you buy something on account, it will increase accounts payable. What is accounts payable? Amounts of items that will be paid in the future. You're going to pay on account means you're going to pay at a later date. If we sold our services on account, it'd be accounts receivable. But what we're doing right now is we're buying supplies on account, meaning we'll pay it later. Accounts payable means the amounts to be paid in the future for goods, services already acquired. What are we gaining? What two accounts are being affected? Bought supplies on account. So whenever we buy supplies, we are increasing supplies. How do you increase an asset? You debit it, right? Move it. All right, account from Canyon Office Supplies, accounts payable, Canyon Office Supplies, that means it's a liability. How do you increase the liability? You credit the liability. So we increase supplies here with the debit, we increase accounts payable with the credit. We must have a debit and a credit. The accounting equation must equal. Okay? And then they kind of explain it again down here. We'll go through that. Now paid cash on account. So what did we just do? We just bought supplies on account. We bought $220. So I went into Bond store and I charged $220. I owe them $220. Well, now our thing is, it says we're paying cash on account. Remember down here, they say what accounts are affected, how is each classified. All right, so we paid cash. How does that affect cash? It goes down, right? Cash goes down. What else is happening? We're paying cash on account to Canyon Office Supplies, $100. How do we decrease accounts payable? Accounts payable is a liability. How do you decrease it? With the debit. So you put $100. So really, in one transaction, we bought $220 worth of supplies, right? We got 220 debit, 220 credit. And in this transaction, it says we paid $100 cash. All right, so we would put $100 credit here, and we put $100 here, and now this would be an updated balance. Kind of see where we're heading? That's where we'll head to. So we charged $220 worth of supplies. We paid $100 worth of it, which means we lower the bill. Our updated balance on our bill, now we just owe 120. Okay? You won't have to do that part yet, but I just wanted to kind of show you. And again, right now, what you're trying to do, and it might seem really goofy, is just remember, when I increase the liability, when I increase accounts payable, when I buy supplies on account, it's a credit. When you pay bills off, you credit cash, and then you debit the bill and make the bill lower. Okay? And then again, they can talk to you here. Down here, remember, you decrease an account balance, record the decrease on the side opposite of the normal balance. They will ask you that on the test. You decrease it with the debit. You decrease it with, blah, 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 or normal balance, and it'll be normal balance, whatever the case may be. If you increase it with one side, you have to decrease it on the other. But that should be lesson 2. Okay. So let's go down here to 2.2. End of lesson. Let's do the working papers for lesson 2.2. Time we get out of here. Oh, we got tons of time. We're flying. Excellent. All right. Working papers 2.2. And again, these are online too. I remember we have this is, so if you need help with it, you can always look at it. I'm going to put Mason away here a little bit if I can pick him up. Nope. Okay. So I hit that little pen again. I make it a little smaller. I slide it over here. I might make this whole screen a little bigger. Okay. All right. So if you see the directions, it says Jensen Cleaning Service. Okay. Listed the account type. Uses a list of accounts. Some of these we haven't even explained yet. We'll do later. Prepare T accounts for each transaction. On each one, decide if what account's going to be affected. So which account? And enter the dollar amount as either a debit or a credit, depending on which account you use. So when they're talking about chart of accounts, this is what they're talking about. These are the accounts we're using. Okay. Cash is an asset. Excuse me. Cash is an asset. Accounts receivable, supplies, prepaid insurance are assets. Accounts payable is a liability. Capital is capital. Drawing is the withdrawal. We're going to call it drawing. We haven't talked about it yet. We'll talk about it next time. Sales is going to be part of capital. Rent and utilities will be underneath owner's equity. But we're not going to talk about all those. We're just going to talk about all these transactions we did. Received cash from owner's investment. We're going to talk about paying cash for supplies, paying cash for insurance, buying supplies on account, and paying for those supplies on account. Okay, so where are we going to get these transactions? On the transaction tab. So first one, receive cash from the owner's investment. We said that was going to be very similar That's going to be something that you're going to see, right? And sure enough, there it is. So how do you receive cash from the owner? What happened? What are the two accounts? Well, cash is being the account that we're using, and so is capital. This is in our notes, correct? You remember? What one are we listing first? We are going to list the debits first. So whatever is being done first is going to be the debit that's listed. So the debit, we increase cash for $4,000. This is John Jensen. If you didn't remember, John Jensen's here on the accounts. This is capital. You don't have to type it out. That's fantastic. We used to have to type that crap out. Now we're getting lazy. Love it. Okay, and then you put 4,000 there. Why am I putting cash first? Because we always are going to put the debit first. Why am I increasing capital? It's his. It's his sweat equity that he's putting in. It's his capital. It's his money. Sound okay? Any questions with this? Just like one in our notes. All right, it says paid cash for supplies, $95. Which two counts are being affected March 3rd? When we have a cash, we says paying cash, and we know we're crediting cash, right? We said that we're paying cash for what? Supplies. So supplies is being debited because that is what we're gaining. Here, where it says paid cash for supplies in your notes, it tells you debit supplies, credit cash, and that just lets you know that your accounting equation equals as well. Excuse me. Okay. Bought supplies on account. So we've done this. This is our notes. Bought supplies on account. Which two counts are affected? Supplies are being gained. And then account supply depot. If you go to your account titles, you see accounts payable is the supply depot right here. So if you got to remember, you go, oh, that's right. We got supplies. I remember this. And you put, we bought $120 worth of supplies from accounts payable supply depot. So now you had to increase the bill, right? How do you increase a bill? For accounts payable, you credit it. How do you increase supplies? You debit it. Debit's listed first. Just like when we did the 221 in our work together, or the notes. It's right here. So whenever you, I'm not going to be mean, but if somebody goes, I don't get it, what do I do when I buy supplies on account? What am I going to probably tell you? Go to your notes. It says bought supplies on account. It tells you debit, supplies, credit, accounts payable. You know, so we're going to have to use these, especially when you can use them. We need you to use them. Okay, March 6th, paid cash for insurance. We can go backwards a little bit in our notes. There's paid cash for insurance. Which two accounts are being affected? We know cash is going down. We're increasing insurance. We have bought something of value. So you'll go prepaid insurance for $250. Our insurance is increasing. We paid cash for it. Whenever you pay cash, you lower cash. How do you lower cash? With a credit. Make sense? Hopefully. These are two assets. One is increasing, so that means the other must decrease. You have two assets in the transaction. To keep the accounting equation equal, one must go up and one must go down. Whenever you see pay cash, you just credit cash. Whenever you buy insurance, you're always increasing. Okay, and then the last one, paid cash on account to Canyon Supply or Supply Depot, same thing. So pay cash on account to Supply Depot. We know when we pay cash, It's a cash is credited. Supply Depot accounts payable is somebody that we charged $120 to before. So again, if you're looking at this, if this was Supply Depot, earlier we charged $120, right? We just did it here. Credit to 120. Now they're paying what? $80. So we're gonna debit it. Their new balance, they still owe 40 bucks. But that's why we're debiting accounts payable. Because it lowers that bill. Cash is decreased, accounts payable is decreased. You label the debit first and credit second. So all we're doing right now is trying to get used to these simple transactions. Which two counts are affected? What is going up and what is going down? We list the debit first. And so I think those are pretty good transactions, right? I think we should be okay. Use these notes, they're helpful. Use this chart, it's right there, it's helpful. 1, 2, 1. And some of you might be getting it, which is even better, that's fine. But it's all about trying to just keep practicing at it. Do a bunch of these so that it becomes, yep, I know how to increase an asset, I debit it. I know how to decrease an asset, I credit it. I know how to increase accounts payable, I credit it. I know how to decrease it, I debit it. You know, you just gotta get used to it. So down here and apply your understanding, we're asking you to do application problem 2.2. All right. You can do application problem 2.2. You guys will work on that. And then after you're done, you're done. We went fast. What is today? Again, I looked at this already. We're out of here at 1:40, so you got a half hour. If anybody wanted to work on something or needed me to extend something, that when you're done with that, come down and tell me and I can get it extended so you can get your grade up. Okay? Otherwise, we're good to go.
I'm done. So can you extend from 3 and
Mm-hmm. One, 3. Yep. I'm going to see what he says on this. Oh, I was going to stop it so that. Yeah, I can go in there while he's thinking about it. Okay. All right. We'll see you, Mace.